How do I manage to trade profitably with a trading AI using a professional approach? That's the question I get all the time. In this video, I'm going to break it down step by step. No fluff, no hype, just the real process behind how I trade. Because what I'm doing here isn't gambling. It's not guessing. And it's definitely not retail-style trading. This is the same structured approach used by hedge funds, banks, and institutional traders. My name is Clinton Deogracius. Welcome to my channel. Before we even get into the strategy, let's be honest about something. Most traders lose money because they chase indicators, enter trades emotionally, don't understand market structure, and rely on signals without context. They're reacting to the market instead of reading it. And that's where the difference comes in. What I'm about to show you is how I combine trading AI, market structure, Fibonacci levels, and supply and demand zones to trade like institutions, not like the crowd. Now let's talk about the professional mindset. Institutions don't just buy or sell randomly. They operate based on liquidity, structure, and order flow. So instead of asking, should I buy or sell? You should be asking, where is liquidity sitting? Where did the last impulse move start? Where is price likely to return before moving again? That's exactly what I'm doing on this chart. And yes, I use AI, but not as a signal generator. I use it as a confirmation tool, layered on top of real market understanding. Let's break down what you're seeing here. We're on GBP/USD, 15-minute time frame. The first thing I identify is market structure. You can clearly see higher highs and higher lows, which tells us the market was in an uptrend. Then we see a shift into lower highs and lower lows, which signals a downtrend. That shift is critical because that's where institutions step in. Now look at the impulse move, the strong push downward. That's not random. That's smart money entering the market. So what do? I don't chase that move. I wait. Now let me show you exactly what I did here. Before the full downside move happened, I actually took a buy trade. At that moment, price was still respecting short-term structure. There was a temporary bullish opportunity, and the AI confirmed a valid entry. So I entered the buy. But here's the key difference between amateur and professional trading. I already knew where I was getting out. I wasn't trying to hold forever. I targeted the supply zone above. And as price pushed into that supply area, I exited the trade with around 10 pips profit. Clean. Controlled. Done. Now watch what happens next. Price hits that supply zone, and that's where institutions start selling. The market then shifts and moves aggressively to the downside. So while many traders would keep holding the buy, get greedy, and give back profits, I was already out because I respected supply. That's the difference. Now let's talk about how I set my targets. This is where most traders get it wrong. I don't randomly place take profits. I use previous highs and previous lows to predict future highs and lows. Because the market moves in structure, and what price has done before, it tends to repeat. So those previous highs and lows become my targets. They are my expectations of where price is likely to go. Now I combine that with Fibonacci extension levels, not retracements, extensions. This is very important. I project levels like 1.1618, 2.1618, and even higher depending on the move. These levels help me forecast where price is likely to expand next. But I don't treat every trade the same. My targets depend on the type of trend and the time frame I'm trading. For short-term trades, I aim for smaller extension levels. For mid-term trades, I target moderate extensions. And for long-term trades, I aim for larger expansion levels like 2.1618 and beyond. The key is alignment. When a Fibonacci extension lines up with a previous high or low and a clear structural level, that's where I take profit. That's precision. Now to simplify it even further, my take profit is never random. It's always based on structure, previous highs and lows, and projected expansion points. So instead of saying, I hope this trade works, I'm saying, this is where price is most likely going. That shift in thinking changes everything. Now where does AI fit into all of this? The AI helps me confirm entries, validate structure shifts, and filter out low-quality setups. But here's the key. The AI doesn't replace my analysis. It enhances it. If you rely 100% on AI without understanding the market, you'll still lose. But if you combine AI with structure, Fibonacci, and supply and demand, that's where consistency comes from. So on your journey, remember this. This is the way hedge funds, banks, and institutions trade. They don't guess. They wait for price to come to them. They use structure. They use liquidity. They use precision. And now, you can too. If you found value in this video, make sure you like, subscribe, and drop a comment below. My name is Clinton Diagracious, and I'll see you in the next one.